Hello and welcome back to our Chapter 5 Short-Term Investments and Receivables lecture. We are picking up with our learning objective number 2, how to apply GAAP, generally accepted accounting principles, to properly account for revenue recognition. So basically, revenue recognition is when you have actually satisfied your obligation to perform or deliver goods. So once the goods are transferred or they're provided to the customer, then you can recognize your revenue. Remember, we recognize revenue when it's earned, and you earn it when your performance obligation has been satisfied, the price is easily able to be determinable, and you are reasonably assured. Reasonably. Obviously, you're not going to sell to people that are not going to pay you, but eventually, as we're going to find out later on in this chapter, not everybody that you sell to pays you. So revenue is basically the amount of cash value that you're going to get for those goods and services. Now, the issue that comes into play here is our shipping terms. So let's assume that we deliver now this truck load of phones to AT&T Wireless. So we have on the truck, there are 30,000 phones and we're selling them for $100. So in your Excel, you should have revenue equals price times quantity, and then we would have our 30,000 in this case, which is our price, times our 100 will give us the $3 million. And so that's accounts receivable and sales revenue. So once we sell that, we're able to do it. So the ones we've performed the obligation, and in this case, they're on a truck. So it's shipping. So here we need to know the shipping terms. So we call this FOB, Freight on Board. So that's another acronym that you should have in Excel if you don't know it. So FOB shipping point is basically, these are when the goods leave the seller's dock. So the best example is if you buy from Amazon, the minute Amazon ships that goods, that's FOB shipping point, they're going to charge a credit card for them. But now FOB destination is when you get delivery. So if you are expecting that custom Rolls Royce, then when they actually give you that Rolls Royce that gets delivered to you, that would be an FOB destination. Usually FOB destination is used for large high price items, yachts, custom cars, and very customized items as well. So we have discounts and that we're offered for early payment. And as I mentioned before, working capital equals current assets minus current liability. Cash is king in a business. Okay, so basically without cash, you can't really run the business. So you are here incentivizing your customers to pay you early. So this is pronounced 210 net 30. And what happens here is you get a 2% discount if you pay within 10 days. Otherwise, the net is due in 30 days, which is your regular terms, usually on the invoice. And the net is your full amount. So make sure you understand that. So now let's go through some examples. So now if Apple offered AT&T those credit terms of 210 net 30 and Apple did pay within the 10 days, then they're entitled to a $60,000 discount, right? Now, don't forget when you're doing percents, it's 02. Remember, you have to move the decimal over because it's divided by 100. So 2 over 100 equals 2%. So now when you're doing that, you're not going to get $3 million in cash. You're going to get $60,000 less. First and foremost, you want to know what happens to cash. So we know that we're expected to get $3 million, but now 60,000 of it is gone. So, right, because as a discount, so this is our discount amount that we calculated. So now we have 2.940 million. And then we're debiting sales discount and we're crediting accounts receivable. And you have to make sure that your accounts receivable is the $3 million that you originally recorded. Otherwise, you're going to have this 60,000 as a hanging item on your accounts receivable. So now is a good time to talk about sales discounts. So we have gross sales minus or less sales discounts. And you should have this in Excel, minus your sales return and allowances equals your net sales. Now also note that sales discounts and return and allowances, they are contra revenue accounts. So if revenues have a credit balance as a contra revenue, these have a debit balance as we see here. Now we're going to talk about returns and allowances. So returns are just that. You actually send the product back to Amazon. Amazon restocks it. But an allowance is if you're probably buying something and they probably say, don't return it, call us if you can't build it. Well, when you're calling customer service, instead of having that product shipped back, pay for shipping, pay for receiving it, pay for somebody to put it back on the shelf, they might give you an allowance. Maybe they'll say, if you keep it, we'll give you 20% off. So sales returns and allowances are usually combined because mostly you see returns. Allowances aren't as common. So now we actually have 100 phones that were returned because they were damaged in shipment. So now what you're going to do is you have the 100 phones, sales returns and allowances for our 100 phones, and then we have our accounts receivable. And if we go back, I think we will see that what our price of the phones were, right? And so we said that we had 100 phones, right? At 30,000 phones at $100. So now 100 were returned. So we'll see here our 10,000 and our accounts receivable. And again, remember, sales return and allowances is a contra revenue account, so it has a debit balance. Now we move on to accounting for and controlling accounts receivable. Learning objective 3 is on your test, so please make sure you pay attention here. Okay, this will be tested. So there are types of receivables. So we have third most liquid asset. Usually we have cash as our first asset. Then we have investments, the short term, the liquid one, right? Our trading securities. Then we have accounts receivable. Most companies do not have investments, so you'll see cash and accounts receivable as 1 and 2. And accounts receivable usually come from selling goods and services. This is trade receivables. Lending money is notes receivable. Non-trade receivables are usually if you give employee advances, if you're expecting an insurance claim, those would all be non-trade receivables. So trade is basically your normal course and interaction of business. So Apple would have phones and iPads and iMacs and MacBooks. Those are all be part of their trade. So now what you have to know to record these items. So if you are performing a service, you're going to debit our accounts receivable balance and you're going to credit service revenue. And for notes receivable, remember the only difference is the promissory note, which usually is a more formal document that you sign. And also remember with a promissory note, there's usually interest attached. With accounts receivable, you normally don't have interest. So there's usually no interest. But with a notes receivable, since it is a more formal promissory note, interest is associated with it, more commonly paid either quarterly, semi-annually, even maybe monthly. So here when you have notes receivable, and again, they're both receivables, so we just debit it, and here all you're doing is taking one asset and converting it into another. So this hits our asset equals liability plus owner's equity side. We're hitting this side of our accounting equation on the balance sheet. So now accounts receivable basically is what you collect from customers. Remember, accounts payable are to vendors. Don't get those confused. But this is to customers. We also call them trade receivables. And we say accounts receivable is a control account, right? What we have is the sub-ledger, which is known as the subsidiary ledger. That's what keeps track of all of the accounts and who owes us what. So here, this would be our control account in the general ledger. And then notice, and we call that a GL. And then in our sub ledger, which is our subsidiary ledger, it gives you the specific customers, what they owe you and how much. And then you would also see details as to basically, if this $5,000, if it was made up of 5 different invoices, that would all be detailed, the date of the invoice. So this gives you your details, and then this is pretty much your total in your AR balance. And notice they must match. So 5, right, plus 1 plus 3 equals 9. So they must match. So now notes receivable. What we have here is that you sign, this is a written promise, which includes the principal sum of money and interest, and it's usually at a maturity date. Sometimes you have to pledge security, and this would be collateral, right? So you have to collateralize the note, and you might say, and usually you might do this with your accounts receivable balance or your inventory balance. So those can serve as collateral for an amount of a notes receivable. Then you may also have other receivables. So in here you might have, basically this is just a miscellaneous category. It's a catch-all. You might put interest and advances to employee. You might also call this non-trade receivables as well. So let's go back to that. So you might have the non-trade receivables. So this is just the catch-all, and it's usually smaller in scope. So now we have our internal controls over cash, right? So remember we said previously that we needed our separate cash handling, right? We had segregation of duties from our last lecture. And basically that if you're the bookkeeper, if you handle cash, you shouldn't record the remittance advices. Those were based on the checks, the forms at the bottom that usually tell you who's paying, what they're paying for. And as you can recall from our previous lecture, we talked about the lockbox system, where a bank employee receives the invoices and then they directly deposit the funds in the bank, and then they electronically send you the remittance advice so you can actually record them in your book. So the person depositing, so it kind of creates that segregation of duty for you. So we're going to stop the lecture here, and we're going to pick up in our next one.